So, what's wrong with defined contribution? I want to explain in this video why defined contribution really doesn't work very well for small employer group plans. And I've got my notes here so you can kind of follow along. But to understand what defined contribution is, it's helpful to know that they were developed off of concepts that were borrowed from retirement plans. So, prior to the 1980s, most people who were covered under a retirement plan with their work were covered under what was called a pension plan. And that was what we would call a defined benefit retirement plan. And what we meant by that was that the arrangement with the pension plan was that when a person retired, they would have a guaranteed monthly payment that would be paid to them, a fixed dollar amount. It was kind of modeled after the idea that their paycheck could continue after they retire. So a person retires under a pension plan, they would get a paycheck of, I'm making up numbers here, but $5,000 a month. That would be the agreement between them and their former employer. In the 80s, and before I go there, I guess one of the advantages that a retiree would have under that is they would have a guaranteed payment. So they would have the ability to know how much money they're getting each month. And the challenge that an employer had was that they would have to come up with this money regardless of how well business was doing or markets were performing or that kind of thing. So in the 80s, the move was to, through legislation, and we don't want to get into the political history, but the move was to go to what they called a defined contribution plan, and that was the 401k. So the idea behind a defined contribution plan was that the employer was no longer responsible for the ongoing benefit that a person would receive, but they were responsible to contribute to a defined contribution plan or a 401k plan, meaning that they would give money to an employee each month. The employee would take some of that money, and then they would go into a marketplace and buy retirement products that they could use to retire from. And so that would be investment accounts, mutual funds, those kinds of things. So just a quick illustration. The other thing was that the 401k operated under what was called a matching program. So the idea is an employee would have an income. So I'll make up a number here. We'll say $5,000 a month. That's what the employee makes. And the employee can decide how much of their income they want to funnel into this retirement plan. And then the employer would have a matching up to some certain percentage. So they'd say, we're going to match, we're going to pay, we're going to basically double whatever you put into your retirement account up to a certain percentage of your income. 3% is kind of an industry standard. So if the employee said, I'm going to commit 5% of my income, the employer would say, well, we'll double it up to 3% of your income. So you take this scenario here, for example, and you'd say, okay, if an employee was going to withhold 5% of their income, then they would be contributing $250 based on that $5,000 monthly paycheck. The employer would match 3% of that, so the employer would pay $150, and so each month the employee would be getting $400 into that retirement account, and then they would use that to build up this investment account that when they retire is theirs and they can use for investment purposes or retirement purposes or whatever they want. But that becomes an important point here in just a minute when I start to discuss why the defined contribution plan does not work under health plans. So when the PPACA rolled out, the Patient Protection and Affordable Care Act, Obamacare, whatever people want to call it, one of the concepts was to borrow from this idea of defined contribution plans and saying, well, let's create this marketplace. They called them shop exchanges. Some states rolled out their own exchanges. Utah did, for example. And the idea behind a shop exchange was it was going to be this marketplace that an employer could go into, particularly a small employer, and there would be a suite of options, health plan options that employees could choose from. So they could buy insurance policies from different insurance companies, different types of products. And what the employer would do is the employer would contribute some dollar amount, some fixed dollar amount to each employee, and then the employee could use that employer money in combination with their own money and go and find a health insurance product that they felt like would be best suited for their needs. And so some of the advantages that people who were advocates of the defined contribution model would kind of promote was that one of the things it does is it gives employees choice. The employees have the ability to go buy the product that they want. And then it would also give the employer cost predictability, because the employer would just commit a fixed dollar amount to each employee. And then when they hire an employee, they would know how much money that employee is going to cost them. So that was kind of the genesis of the defined contribution model and theory. And then the defined contribution model today exists, but it's been kind of broadened and applied in different ways. So we still have the shop exchanges, so that mechanism still exists that employers can use if they want to. We've seen what we call single insurer exchanges. That's when an insurance company, XYZ insurance company, comes in and says, well, we'll basically create our own type of exchange product where you can buy our service, contribute money on a defined contribution basis, and then your employees can buy any one of our insurance products that we make available. So each employee can have a different product, but they would just have that within one insurance company's range of options. Some employers are using defined contribution just on a payroll withholding basis. They really like that idea of having the predictability. So they say, we're still going to choose we're going to choose the products, but we're going to withhold just based on a defined contribution. We'll give you a fixed dollar amount, and you choose to enroll how much of your family or whatever, and then the difference comes out of your pocket. And then ICHRA, the individual coverage health reimbursement arrangement, that is also a place where defined contribution strategies are being applied. So let's get into what's wrong with defined contribution for health insurance. And a big part of it comes down to the strategy for financing, and it's the matching strategy versus the price problem, I would really call it. Under a retirement plan, an employee can contribute as much money as they want to. If an employee wants to contribute $1, technically they could probably do that. With a health insurance product, the product has a price. It's a fixed price, and that's an amount of money the insurance company expects to receive if they're going to offer coverage. So there's this problem that you have to hit the price in order for the defined contribution strategy to work under health insurance, whereas under retirement, an employee has the discretion to what the total value of the contribution will be. And so there's not this requirement to meet some price, and obviously an inflating price when we're talking about health insurance, a price that continues going up year after year after year. The big challenge comes from the way that health insurance is priced. And so what we have here is we're looking at a table, and don't worry about needing to comprehend this, but this just gives you an idea of how health insurance is priced both in the small group market and the individual market. So that'll affect ICHRA products. What the insurance companies do is they create a table that has a list of ages on it, an age for what a member's age would be, and then we have a product. So we've got, ignore the age factor, I could explain that in another video, but we've got what I'm going to call the baseline product for now. That's just an insurance policy. You find a member's age. If they're 27, then the price for that product is $314. And then you'd have multiple products, and so this will make sense in a second, the superior and inferior product, but these are just different insurance policies that members could buy, and you'll price them out and say, okay, which insurance policy do I want based upon the benefits and based upon the cost. But let's visualize this before we go too far, and I'm going to modify this graph to make it just a little simpler to read for a second here, and then we'll get into some detail. So this is what the age curve looks like, and the shape of the curve is going to be the same for any product, because the curve itself, the shape of how price goes up according to age, is determined by law. The only thing that it changes is the reference prices. So this curve can move up or down, but the shape of the curve is going to stay the same. And so the idea is you're looking here on the horizontal axis, you're looking at age, and on the vertical axis, you're looking at the cost, or the rate of the insurance. That's the price. So as your age goes up, the cost is going to go up exactly according to this curve. So you can see that when you hit about 41 or 2, you really start to see a steep shift in the rate at which the cost goes up from person to person. So why does that become a problem? Well, let's put in a few more plot points here, and I want to just say, if you were trying to put together a defined contribution, and actually want to rescale that for a second. We'll go to, okay, so it just looks better. If you're trying to come up with a defined contribution as an employer, what you're trying to find is some middle of the road, some sweet spot that you can say, if I give the employees this much money, it will work out more or less good for each employee. And as you can see, this is this line right here is the median price. It's the center of the road price. If you just took all the prices, laid them out in a row, and found the middle, that's what this red line represents. So as you can see, it's at when you look at where it sits proportionally to the total curve, it's about at the 25th percentile. I mean, it's the highest cost is up here, which is $900, and that'd be for a 64-year-old employee. And it's almost 3 times the value, not quite, but it's pretty close to 3 times the value. I'm eyeballing it here for a second, but of the cost of a 42-year-old. So if you've got a population that is spread along this age continuum, the effectiveness of one price for each employee is going to be massively varied. And so ultimately what's going to happen is that the younger employees are going to be overly advantaged. So if you had an employee that was in this range right here, they're actually going to have surplus money, and the employees that are in this range right here, they're going to have to come up with a substantial amount of their own money. So what some companies started to do is they said, well, maybe we can take this curve and break it into a few more pieces, and so they would do something like this. And what we're doing here is we're adding percentile ranges. Let me recalibrate the chart here as well. So what they would say is we're going to break it into ranges. We'll say, well, for employees under the age of 40, we'll have one defined contribution, and for employees older than 40, we'll have another defined contribution. And conceptually, again, that sounds good, but when you just look at it here on the table, an employee whose age is right here is going to be overly advantaged because they'll have a surplus of the distance from here to here. That's if you chose the center of the road as your defined contribution value, and an employee that's up here is going to have to come up with that amount of money right there. So from here to here, really. So, and you know, I'm just eyeballing it again. That's about $250 that the employee will have to come up with out of their own pocket, and the employee down here would have a surplus of about $150. So you find this strange arbitrary inequity that takes place. And that's when we're only looking at one product. Now, you say, okay, well, what about ICRA? Because if we look at an ICRA or we look at a shop exchange, the employees have the choice to choose between different products. So let's throw the other products on here, and I'm calling these the inferior and superior product. Now I need to rescale this. Okay, so what we've done is we've added 2 more insurance products to the mix, and it kind of represents what would happen if we had 100 insurance products. You're going to have them on a range of quality. Some plans are better than others, and if you said, okay, we're going to choose some sort of a baseline plan to structure our contribution for, well, what's going to happen is if this is our baseline plan right here, and we want to set our contribution right here. So we're going to set it at maybe $600. What's going to happen is the employees up here are going to have to come up with $250. So in order to kind of manage that, these employees are going to be pushed down to an inferior product. So your older employees are going to be incentivized to find insurance products because that are worse than the baseline, because as you can see, the cost threshold here is much lower, so a 60-year-old employee could actually walk away with a little bit of surplus money, but they have an inferior insurance product. And then the younger employees. So if we had an employee that, let's say that we set our baseline, we'll just set it right here, where we're in the 25th percentile. You've got this employee over here might be incentivized to grab one of these higher cost plans, or it's even more accelerated over here. So you'd see this employee might want to grab a superior product over here. So the younger employees want to take the better products, and the older employees want to take the inferior products, which is kind of counter to the way health insurance works. Health insurance really works by providing people with the coverage they need when they need it. And so as we get older, we tend to need more health care, which is why the cost is higher for older people, but it creates a weird reverse incentive where we encourage people to have worse coverage when they're entering those years when they need it most. So long story short, defined contribution really does not work as a health insurance strategy, because health insurance strategies have a price that you have to hit. So you don't have this ability to just pay what you want according to a match. And the age rating is the reason why. It's because the age table changes the game from being a match situation to being something that you have to hit targets, and those targets are arbitrary according to age. So anyways, long story short, I think you should not be using a defined contribution strategy in most cases. There are better ways to handle it, and we'll cover those in the next videos.